The tax year end is on the horizon, which means it's the perfect time to chat about pension funding. It's all about making the most of those allowances before they vanish. But guess what? This year has some cool, fresh funding opportunities for you to consider. The pension funding scene has had a major makeover. What's really grabbed our attention is the action of the lifetime allowance charge, the boost to the annual allowance, and the increases to both the money purchase annual allowance and the tapered annual allowance. This means there's a bigger allowance up for grabs for almost everyone, leading to the chance for larger pension contributions. In this video, I've put together a checklist of 12 things that might nudge you into action before the end of the tax year that could leave you and your financial future in a much better place. First up is the annual allowance. This year's annual allowance is a whopping £60,000, an increase of £20,000 over last year. The extra room to pile more into pensions could take the sting out of higher tax bills for some people whose earnings have tipped over the higher rate or additional rate thresholds. Remember, the personal allowance and basic rate bands have been frozen since 2021, and the threshold for paying additional rate tax has been cut this year from £150,000 to just £125,140. With the freeze expected to last until 2028, more clients will be pulled into higher rate tax bands. A pension contribution will stretch both the basic rate and the higher rate bands by the gross amount. There might be a reason for delaying funding in Scotland until after the tax year end, as income tax rates are set to climb, and so more relief could be available in the next tax year. But remember, if you delay, any unused carry forward allowance from the year 2020-21 will be lost. Second is carry forward of annual allowance. The lift in this year's annual allowance plus unused allowance carried forward from the last 3 years allows a maximum contribution of £180,000 for those that took a break from pension funding, but you'll need to have enough UK relevant earnings in the current tax year to get a full relief on those individual contributions. Third is no lifetime allowance charges. Since there's no more lifetime allowance charges when funds are crystallised, those who hit the brakes on funding to stay within the lifetime allowance are back in the game. If this is you, you might want to kickstart your pension savings again. Even if your existing benefits grow over the new lump sum allowance, meaning you can't get any more tax-free cash, pensions can still be a great place to save. If the tax relief received on the contributions mirrors the tax payable when benefits are taken, then it's tax neutral. But of course, the pension pot will generally be free of inheritance tax and still enjoy investment returns free of income and capital gains tax. This is kind of like an IHT-free ISA. The only situation when a client's tax position in retirement is likely to be higher than the relief on the contributions will they be worse off. For example, if they were due all the benefits in one go. This is a bad idea for most people in most scenarios imaginable. If in doubt, don't take it all out. 4. Clients with protection. Those with either enhanced or fixed protection will have stopped putting into their pension years ago as a condition of keeping a higher lifetime allowance. As there's no longer a lifetime allowance charge, the protections will only relate to tax-free cash and perhaps more importantly, will not be lost by making new contributions, provided the protection was in place as at the 15th of March 2023 and hadn't been lost or revoked before the 6th of April 2023. Since they haven't made any contributions in the last few years, they could contribute up to £180,000 used and carry forward as long as they have enough earnings to justify a personal contribution and are not subject to the money purchase annual allowance or tapered annual allowance. More on those in a bit. 5th is the enhanced protection and the lump sum death benefit allowance. Clients with enhanced protection will have their lump sum and death benefit allowance limited to the value of their uncrystallised rights on the 5th of April 2024. Since they can restart pension funding since the 6th of April 2023 without messing up their protection, this means there's a final chance to boost their lump sum death benefit allowance by making a contribution of up to £180,000 using carry forward before the new tax year starts. 6. Adjusted income limit for the tapered annual allowance. The adjusted income limit jumped by £20,000 this year to £260,000, so fewer people will be hit with a tapered annual allowance charge. For those with earnings over £360,000, the minimum annual allowance also jumped to £10,000, previously just £4,000. Both open the door to larger contributions. The threshold income limit stays at £200,000 and any personal contributions will be deducted from income to see if this limit is exceeded. If the result is a figure below the threshold income, then there will be no tapering and the full annual allowance will be up for grabs. 7. Money purchase annual allowance. The money purchase annual allowance went up from £4,000 to £10,000 this year. This could give extra room to pay in for those who have retired and started to draw pension income but have returned to part-time work in some way. For those who are thinking about retirement but have not yet triggered the money purchase annual allowance, there's a chance to boost their pension savings using a full annual allowance and any unused annual allowances carried forward, both of which will disappear if the money purchase annual allowance is triggered. 8. Bonus sacrifice. The tax year end often lines up with a business's year end, and for some employees, this could mean a bonus payment. Swapping a bonus for an employer pension contribution before the tax year end can bring a bunch of benefits. The employer and employee NI savings made could be used to boost pension funding, giving more in the pension pot for every pound lost from take-home bonus pay. 9 is for business owners. The main rate of corporation tax has leapt from 19% to 25% this year. Those with profits over $250,000 and paying at the main rate will therefore get more tax relief this year. Indeed, some may have delayed funding last year for that very reason. Companies with profits between £50,000 and £250,000 will not pay the full 25% rate of corporation tax on their profits, but will still get more relief. Often directors will take a big chunk of their profits as a dividend. Dividend rates went up last year, but they are still less than income tax rates. But remember, dividends are paid from the profits after the deduction of corporation tax. This means that using some of those profits to make an employer pension contribution with full corporation tax relief instead can be a smart move. 10. For the self-employed. Self-employed profits will be aligned to tax years from April 2024. Until now, profits have been assessed on the annual profits in the business year ending in the tax year. This tax year is a transitional year, which could mean that taxable profits will be based on an extended period, although there are rules that allow these extra profits to be spread over the next 5 years to prevent a hefty tax charge this year. For example, in 2022-23 tax year, a self-employed person with a business year ending on the 30th of April would have been taxed on the 12-month profits to the 30th of April 2022. This year, they'll be taxed on the profits made in the year to the 30th of April 2023, plus the profits made between May 2023 and the 5th of April 2024, a period of 23 months. Even if these extra profits are taxed over 5 years, there could still be a spike in profits and therefore an increase in pensionable earnings. A larger pension contribution could be considered to boost savings and take the edge off some of that extra tax liability. 11. Retention of personal allowance and child benefit. Personal contributions can help get back personal allowances and child benefit as they're seen as deductions from earnings. The personal allowance is cut by £1 for every £2 of earnings over £100,000. Child benefit is assessed on the highest earner of a household and is cut by 1% for every £100 of earnings over £50,000, although this has recently been changed to go up to £80,000. And 12 is tax efficient planning for couples. For couples, think about maxing out tax relief at higher rates for both before making contributions that will only secure basic rate relief. Many clients won't know they can top up pensions for their partners, and not just by £3,600, but up to their partner's relevant earnings. Tax relief will be given at the partner's marginal rate of tax, and remember, should disaster strike, a pension can be inherited by a beneficiary but outside the estate for inheritance tax. This enables pension withdrawal strategy to continue for the surviving partner following an early death. So in summary, what does all this mean? Well, in my mind, it means pensions still win the prize for being the most tax efficient way to save for retirement for almost everybody. This is because part of the benefits can be taken as tax-free cash and overall returns boosted by the possibility that tax relief during the client's working life will be higher than the tax paid when the income is taken out in retirement. Now, good tax planning is a year-round gig, but it's only when the tax year ends that you have all the information needed to utilise the allowances and reliefs in a tax-efficient way. This could give a lift to savings, but remember that, in most cases, allowances not used before the end of the tax year will be gone for good. Now, we're looking to grow this channel, so it'd be great if you could hit the like button, subscribe to the channel, and ring that notification bell so you don't miss out on our next video. Till next time, take care.